All right, guys, welcome back to the Educated Homebuyer Live, where our goal is to help you buy right, borrow smart, and build wealth through real estate ownership and financing. Josh will be back here and joining us shortly. I think he's popping in right now. Probably had to comb his hair,
Yeah,
do something.
I was in the restroom, doing the coiffure, whatever the fancy French word is for it.
Nice. So someone reached out to me recently that saw the show and didn't know who Josh was because I never introduced him. So Josh is resident mortgage broker here. He's the gentleman who I send the majority of my clients to get pre-approved to buy houses. Known Josh a long time, an expert in the business, partner on the Educated Homebuyer podcast, and again, a valuable asset to you guys watching. So, Josh, welcome back.
Thanks for having us. Sorry we missed you last week. We were in the air last week, returning home from Lake Tahoe.
No, yeah. So, I got more likes and more views than when you're here. So I'm beginning
It's
to
funny.
wonder.
It's funny that's the story every time.
I'm
So I
beginning to
don't know.
wonder if
I don't
there's a
know.
problem with my guest.
Yeah.
But no, let's talk a little bit about what's going on in the market at the moment. So today, existing home sales came out, right? So down 5.4% from last month, down nearly 15% year over year. And we're going to pull up some graphs here in just a little bit and talk about existing home sales. But what that's translated to is more inventory on the market, right? So we've got 9.6%. We're up 9.6% from May, up 2.4% with regards to inventory year over year. Some markets are seeing bigger increases. California saw a 20% increase year over year with regards to, from May, 20% increase from May with regards to active listings. And some other things out there that we'll talk about, but let's talk a little bit about interest rates, Josh. At the moment, 2 weeks ago when you were on, I think we got the CPI numbers. Now, right, the market's kind of moved sideways since then. Not a lot's changed. We have a Fed meeting next week. Obviously, that's maybe going to bring some volatility to the market. But what are we seeing right now with rates?
Well, if you look from basically the end of June, beginning of July to today, almost no movement. We're in the same spot. So rates had improved and then now have kind of in the middle of that range. So for you guys watching at home, the easy thing is to look at the 10-year Treasury. Mortgage rates don't follow in lockstep, but they follow fairly closely. And we're in a range between about 3.00 and 3.1. If you look at the chart pattern, it's a pennant form or a wedge, and it means it's going to break out one way or the other. So on one side, Jeb, we've got the whole thought that inflation is still out of control, so that would lead towards a breakout to the higher side on yields or interest rates.
Right.
On the other side, we're getting a lot of economic news showing the economy slowing, and that would lead us to believe in a breakout to the downside. If you're looking at the technicals and reading it as much as you can, I would probably lean towards a breakout to the downside, lower interest rates, lower yields, but for the most part, it's a coin toss right now. So for clients, what our belief is. If you have a rate and you're comfortable with it, probably lock it, just because when they go up faster than they come down. And I'm not expecting any huge run down in interest rates where you're missing a whole lot if we did have some improvement. So for the most part, you have your government loans in the high 4% and your conventional loans in the low 5%. When I say for the most part, the thing that's important to remember, high balance purchases have a 1-point hit, which is going to be 0.25% higher across the board. Condos with less than 25% down have a 0.75-point hit. Heaven forbid you're here in Southern California and you get a high balance loan on a condo, that 1.75 is going to add about 0.5% to your interest rate. So rates are better than they have been. Still have some options, especially on the jumbo loans for the hybrid ARMs, 7.6, 10.6 that can be in the low to mid 4s and still get you a fixed rate for 7 to 10 years. So the good news is most of that volatility is gone. You mentioned next week's Fed meeting. I don't think the meeting's going to be all that surprising. There could be some news in the notes, which the notes usually come out the following week, I believe.
Right.
So if they tip their hand as to where they're likely to go in the future, it could give you some information. One of the services that I follow had some interesting information. The Fed futures market is predicting by June of next year they will have had at least 0.25% cut. So that's not to say that they're discounting or not believing that we're going to have more hikes. We are going to have more hikes throughout the rest of the year. Their expectation is that the economy will definitely have slowed, and we will be looking at rate cuts by the middle of next year. And I say that's just the markets, the futures markets, people actually wagering money on what's likely to happen.
Yeah, and with that being said, I mean, initially after what the last CPI reading at 9.1%, the majority out there, the consensus was, I think it was about 50% saw that. Well, I say the majority. It started less than majority thinking a 1% hike next week, and then it got up over 50% of
over 50%.
Yeah, that I think up to maybe 80% or so that. They believe that it would be a 1% hike. And now I think it's down to like 12% believe it's going to be a 1% hike. So the majority of people out there that are betting real money on this seem to think it's going to be 75 basis points. And when I say real money, there was actually I think a trader from Goldman Sachs that actually put a real bet on this whole thing and has been making money off the idea that it's going to be 75 basis points versus a full point. But nevertheless, we're going to find out Wednesday. But like we've talked about before, a lot of this is already built in, right? Unless there's a huge surprise either way, probably not much is going to change on the interest rate front.
Like I said, I think it would be much more some surprise, something in the notes. But again, these people that run the Fed, they're not dumb. They're removed a little from the markets. They do some crazy things, but they're highly educated, highly intelligent, and Fed speak is a real thing. They know how to say things without alarming the market. So I really wouldn't expect much movement either direction in the near-term future.
No, for sure. But if you're in the market right now, you're looking at inventory, it's definitely gone up right here in Orange County, sitting just over 4,000 properties. That's a number I haven't said in 2 years. 4,002 as we came on the show, Huntington Beach at 254. So if you've been following this, at any point along the way, you're seeing these numbers continue to go up. So what that means is obviously more options for buyers to choose from. There are homes sitting on the market longer. That's why you're seeing days on the market go up. At the same time, what I'm saying is that, and I just did a video on this. It's going to come out Monday where I, give you a California update more specifically, but I'm putting in offers out there on property. And, I had one that just sold for $50,000 over the asking price. We lost to a cash offer at a $1.2 million price point. So it sold for $1,250,000. There were 3 offers on the property. Things are still moving, and it's pretty aggressive out there, depending on what you're looking at. And in that video, I actually talk about which properties are selling quicker, which ones are sitting a little bit longer, and what to kind of expect depending on what it is you're looking for. But Josh, we talked about existing home sales initially, right? So you look at the headline, and it looks awful, right? I mean, sales declined 5.4% month over month, 15% year over year. And I'm not trying to sugarcoat it, but what I will say is that we're moving into a slower time, right? Just seasonally, we're starting to get some of the normal market back where things slow down after that May-ish time frame as we move into summer when people are taking vacations and out, doing stuff with kids and not necessarily house shopping. But even with that being said, I want to pull up a couple of charts here. These came from Calculated Risk, which actually he pulls a lot of his stuff from the National Association of Realtors. But we're going to pull this up here, Josh, and look at existing home inventory. So this is home inventory. So we talked about inventory rising initially. We'll get into home sales here in a minute, but look where inventory is now as we're halfway through 2022 compared to you want to go back as far as 99, right? We're still significantly lower than those timeframes. And now existing home sales. This is one I like to look at because I think it's an interesting chart to compare the last 3 to 4 years, right? So we have 2 crazy years in there, 20 and 21, and the beginning of this year was a little nutty. But then you got 2019 in there, and then you got a minimum, which is a bust, right? And then you got a max, which they're saying is a bubble based on the number of sales and what have you during that time. And so if you go back and look at just this year alone, we've been trailing a little bit from previous year just based on everything going on, but we're still way above that bust level and still far below, significantly below what they would consider a bubble level. So existing home sales, while it's down, it's still higher than it was in 2020 at this point, about where it was 2019, it looks like, in June. But you're going to see these numbers decline. As we move through the rest of the year, sales are going to slow, right? The June numbers, what you have to take into consideration with June is those are properties that likely went into escrow in April and May. And interest rates didn't peak, Josh, until I think sometime in June, early June. So the full effect of interest rates hadn't hit the market at that point. So when you see July's numbers, that means those are buyers that went into escrow in May and June. Well, June is going to be a slower month. August is going to be really one of those big declines, especially year over year, because August last year was a pretty hot time in the market. So just providing a little bit of context to the headlines you're going to read out there. Again, we're not trying to get you to buy a house, but it's just good to know the information so that if you're thinking of buying, you know what you're looking at. And I have another slide on here and I forgot what it was. This is non-seasonally adjusted home sales, I believe. So just shows you where we compared to last year without the seasonal adjustments in there. So obviously declining. And I would imagine that red bar is going to continue to trail down, whereas you can see the blue bars kind of from last year stayed around that 6,000 or 6 million level throughout the entire year. Whereas, we're just above 5 million at the moment. So anything you want to add on that, Josh?
No, I love these charts. One of the best ones, and I think it is the gentleman from Calculated Risk does this. It's been helpful the last few years in 2020 and 2021 to kind of look back to say, okay, where was 2019 prior to the craziness, and what has it done? But like I said, I believe it's the guy from Calculated Risk. A lot of times he'll use a 2015 to 2018 or 2019 average. If you look back, those were good times in the market. The market was appreciating, but fairly consistently and fairly slowly in that 4 to 5% range. And it's a good number to look at for comparisons. When we get below those figures, it will be informative. And one of the things I always like to go back to, everyone wants to think there's only two potential outcomes. We can have just a continued boom where things keep going through the roof, which we've talked about. They can't just go parabolic forever.
You realtors think prices are going to go up forever.
Yeah. And again, they can't do that. You hit a wall of affordability, and we hit it sooner than what we thought because rates also shot up at the same time. There's three components to affordability. One is the home price, which we know was going up. Interest rates shot up more than anyone thought, and incomes haven't gone up at a rapid enough clip to keep pace. So if we look forward, what's likely to happen to home prices to bring affordability back in line? That's what you need to continue to see rapid appreciation or appreciation of any sort. So incomes are likely to continue going up, although not at a high rate as most people would like or hope or think. Quite likely that interest rates are going to moderate, but not go back as low as they were. So the third alternative is not a bust, not a giant crash where home prices drop 25, 35%. They can go sideways or close to it for an extended period of time. And that's a lot of what we saw from, say, 2010 to that 2014 timeframe. They were going up a little bit, but they were just kind of going sideways as rates were low, incomes were increasing, and it brought affordability back in line. Affordability drives home price increases. So when you see affordability at low levels like it is now, it's unrealistic to think we're going to see big price gains going forward. But we've talked before about limited supply, limited number of sellers. I have some clients right now that are going to be moving to Texas. And for them, there's even they who are going to be trading a $700,000 house in Corona for a $500,000 house that's twice as nice in Texas. They're looking at it going, why are we doing this? Why are we trading our 3% rate for a 5.5% rate? So imagine sellers that would be looking about moving across town and moving up in price. That's someone moving across
I mean,
the
talk about
country
me.
to a
Let's talk
lower
about it.
price. Yeah, let's do it. Let's go. You've got a
I
good
mean, I
example.
kind of had this conversation yesterday, or last week rather, on the show, and people saying, "Would you buy in this market?" And I'm thinking, "Yeah, if the right house." And so yesterday, my wife and I went and looked at a property here locally. In fact, I had Josh go look at it afterward, just to talk some sense into me because it's going up considerably in price from where I purchased my house, and even quite a bit from where I could sell my property. But the goal is to keep my property and not sell it anyway. But it gives me one more bedroom. I have a 3 now. It gives me a 4, and it gives me maybe 200 square feet more, maybe. But the layout downstairs is pretty similar to what I have now. I just gain it upstairs in an additional, or I guess downstairs in an additional bedroom. But it's going to cost me about $500,000 more than what I could sell my house for now. And my payment right now is based off a 2.99% interest rate. So not only is my rate going up quite a bit, I'm paying significantly for more for that property, significantly more for the property taxes because of when I bought it. And so, it's something that we really considered with regards to the house, but at the end of the day, it's just not, it doesn't meet everything. And therefore, we don't have to move. We don't have to do anything. So we're kind of in that position where we just sit and we can wait because we don't need to do anything. And that's a lot of people out there at the moment in just various situations still looking for the right property. Even though inventory's gone up considerably, there's still not the perfect property on the market. And it doesn't have to be perfect. There's just certain things we want in it, right? Non-negotiables, Josh.
Jeb, let me ask you a question. So we have a time machine. We can go back in time a year, and that home is 1.4 million, 450-ish, and the rate is 3%. Does that affect your decision making?
I think so, right? To some extent. I mean, maybe. I mean, at the end of the day, it still doesn't give me the square footage that I need, right? Would I pay $100,000 more to have the square foot that I need? Yeah, I would. And see, I could keep my property that I have now, right, which I plan on keeping it anyway, and do an addition and probably gain close to the square foot that house allowed me for a lot less money. And so, those interest rates are definitely enticing when I look at the, what the payment would have been, but I'm less worried about that and just more worried about finding the right property for me. I don't know if that makes sense.
No, absolutely. And one thing that you said, that property was a completely renovated home. So
Right.
it's going to be desirable. Your brother-in-law and sister-in-law are looking at homes, and they only want the beautifully renovated home. So those homes, they're still in bidding wars. So I sort of instructive, those same clients that are moving to Texas spoke to their realtor here and found out that they wanted to list for 775 because the most recent home in their neighborhood sold for 775. Well, it also happened to be gorgeous, perfectly redone, recently redone, and that home sold really fast over list price. And they are on the market at a lower price and having showings and got offers, but not. So it really is a tale of two markets right now. Those really desirable trophy turnkey homes are still in demand and still going for premium prices. And we've talked about this before on the show, like a year ago, 2 years ago, the worst deal out there was a fixer upper because people were overpaying relative to the condition of the home plus what it takes to make it nice. And
Right.
now the ones that are really being overpaid for are the ones that are turnkey. So if you have some time, patience, money, if you're handy, you have a good contractor that's reasonable. And you know what? One of the things we haven't seen yet, Jeb, I haven't heard any stories yet of contractors coming down off of their prices. But when you look in the builder space, all of the big national builders are going back to their subs and they're renegotiating contracts. Framers are coming down off their prices.
Right.
We know lumber prices are coming down, but labor and materials are coming down. So it'll be interesting to see what happens going forward. I wanted to throw one out here. It was actually just a comment on something that I had said. Philip Sheridan made a good point here. Going sideways in nominal terms means going down when inflation adjusted. So nominal terms means, let's say home prices go up 1 or 2% a year for the next few few years. It's going to look relatively flat there. But when you say inflation over time is at 2%, currently at 9.5%, it's actually coming down in inflation adjusted dollars. And that's what we see. The funny thing is homeowners don't think in real returns. They in real return terms over the last 30, 40 years, homes have provided an excellent return, and it's also leveraged, so it increases that. But it is important to note that going sideways would be a loss in value in the home when you're inflation adjusting it. That is 100% correct.
Yeah, no, and the same thing with incomes, right? I mean, you hear incomes have increased 4 or 5% or whatever the number is. Well, in nominal terms, they haven't because of inflation. So, but again, most people don't think like that. Just like most people worry about their monthly payment and not necessarily the price of a property. And that's why low interest rates fueled a lot of the craziness that we saw because payments were lower. And in many markets, it was less than it was to rent. So we're going to dive into some questions here in just a minute. But one thing we didn't touch on, Josh, was building, right? We got new builder numbers, single family permits or completions or whatever it was that came out. And it basically shows some slowing with regards to single family homes. And we talked about this a little bit, in the past, is that, nationwide, we still have a record low amount of inventory. Even though it's increased, it's still considerably lower than it should be. And builders are needing to build way more homes to meet, demand. I think they need to build about 500,000 more homes per year for the next 10 years to meet demand, or what they're speculating to be the numbers that need to be met. And so what happens is economic slowdown in the market, recessions, whatever you want to call it, is going to put a halt on some of this construction. And guess what that's going to do? It's going to kick that can further down the road, with regards to properties being completed and supply actually hitting the market. So there are going to be markets that are overbuilding property because there's available land and it's easy to build and it's more cost effective to build those properties. But then you're going to get markets that are more dense areas that, it's more expensive to build, less opportunities out there to do it. And therefore those markets are probably going to continue to have strains on inventory, especially long-term. So all
Jeb,
that said, yep.
I don't remember the article that I saw, and I don't know if you saw it, but it was awesome that they took quotes. It was a survey of sales offices for builders around the country.
Oh, I did see it.
And
it was a calculated
amazing
risk. Yeah,
I think it was calculated risk, and it was amazing. The variance. Some of these people were like, we're still got good traffic and we can sell everything we have, and other markets were like, we don't have half of the foot traffic we had. So, it's a little bit about what we talked about. You need to be aware in your area how much new inventory there is, how much is coming on the market. For us in Southern California, unless you get out in the Inland Empire, we're pretty much built out. There's not a lot of new construction. So the ones that there are a lot of buyers who like that turnkey, walk in, sign a contract versus getting into a negotiation with a seller. So it'll be interesting to see how that plays out, but definitely know your area and know what's available if you're thinking of new construction in the current market, so that you can know, are prices going to remain firm, or are you going to have a little bit more wiggle room in terms of what you can do with the builder.
No, absolutely. And like you said, with the builders, it's the same conversations I have with real estate agents out there in some of these groups that I'm in masterminding and talking about stuff. I talk to some agents like, hey, listen, my market's still, we're still selling. It's still moving. And then you talk to other people like, no, it's slowing. We're feeling the effects. And so it all depends. I mean, a lot of it has to do with price points. A lot of it has to do with where you are, how much new construction, like Josh mentioned. So just know real estate's local. And make sure you're working with a professional mortgage expert, real estate expert when you're doing it. There was a link scrolling across the bottom, which I'll throw up here in just a minute again. But before we do that, I'd like to ask, if you find any value in the first part of this show where we talk about, economics, what's going on that affects real estate, before we dive into the questions, do me a favor, hit the thumbs up, and let us know that you like this sort of thing. It helps us. And then also, if you want to follow on social media, you can do that. There's the links there. A lot of you guys are asking, have reached out. A lot of viewers email me I get a lot of emails and what have you asking for different stuff and articles that we read. And Josh and I started thinking and trying to put together maybe, a way to get some of the stuff out there, good content for you. So what I'm going to do here is throw a link up on the screen. And I think I'm going to throw a link up on the screen here. I'm going to do this right here. So newsletter. So if you want a free newsletter on kind of a market update, a recap, if you will, of what's going on, with some articles that Josh and I are reading. Some of it might be paid, so it might be hard to access it, but we'll try to get you what we can from it. Go there, subscribe to the newsletter, and stay updated on basically everything real estate related, everything that's going on in the market. So lastly, the podcast. If you're not listening to it, you're behind the curve, right? It's just blowing up. It's blowing up. Now, there really are a lot of people listening to it, giving us positive feedback. But we'd love to hear what you guys want us to cover. Again, it's separate from the show. Let us know. Reach out, listen to it. Let us know what you think. So anything you want to add on that one, Josh? And before we dive into any questions here, my friend.
No, let's jump in and answer some questions.
All right. So we got Jennifer Lego back. Thank you, Jennifer, for being here. Our moderator. If you act up, she will act out. So just remember that. Let's see. Hope this live is better and more energetic than Jeb last week. Wow. Listen to that, David.
Where are all the compliments and the likes and the
Dude,
the
I
more
don't know.
viewers that you were talking about?
I feel like David's questions probably aren't going to get answered tonight. I don't know why. That's just a feeling I'm getting. No.
Clearly we see the energy's down when I'm not here to keep it up.
No, well, clearly you're a ball of energy, Josh. So that's
I've been told that. I've been told that everywhere I go.
All right. Any thoughts on the Lake Arrowhead, Crestline Mountain Communities real estate market? So these are second home communities for most people. These are in Southern California. I don't follow them directly, but what I will say is those second home markets are going to probably have a little bit of a breather. Just because of interest rates going up. The second home market got affected by some of these hits and fees that were added. So that plays a part in people wanting to do it. Some of the payments don't make sense now because of where prices have gone. So I think you'll probably see a moderation there, but at the same time, people need to sell, right? Because inventory has been low up there. I don't follow it enough to know. And a lot of it has to do with what happens during the winter. Do we get a really good season? If we do, then demand stays pretty high during those times. Whereas, if it's we get no rain and it's dry up there, there's no snow, you have more people wanting to get out, just because they're not using the property. All right. We got Willing is here, just cutting loose. Jennifer Lego has a question though. It says on a $150,000 loan at 3.625% over 30 years, how much did I save putting 15% down versus 5% down? Josh?
Jennifer thinks we are walking spreadsheets or financial calculators. So there's a couple of things here. We'll run the numbers. I mean, actually, Jeb, make sure you leave that question up so I can take a screenshot of it and send her an email with a better answer than what we're going to give right here. But a couple of things that you want to take into account. So you saved on mortgage insurance. It was either lower or it may have made sense to take a no MI option with 15% down where it probably wouldn't with a 5%. You have a smaller loan, so you're saving interest on that additional loan and you don't have to pay the principal on it. So you had a lower monthly payment. But one of the things you want to look at there, that additional 10%, there's an opportunity cost. You don't have that money available to you and you're not earning a return on that. So we would have to put in a number that you're comfortable with. People love throwing around long-term averages for the stock market of 7 to 8%. When you factor that in, it probably would have been better to put 5% down. But this is where we talk about it doesn't matter what the spreadsheet says. We want to look at the numbers and then whatever your gut tells you is the right answer. Obviously, for you, having a lower payment was more comfortable than having an additional 10% available for investing or doing other stuff with. But I will pull out the old trusty spreadsheet and I'll run you some better numbers. How about that, Jennifer?
There you go. Look at that. Personal personal concierge to the real estate.
If you show up
Market.
every week for every live and moderate, you too can get your own questions answered through email.
There you go. Shelly, Josh, and his team are incredible. We loved working with them. So I don't know the name Shelly, Sherry. I'm sure you do, Josh. So
I do.
look at that. Got some people in there giving you a shout out. So if you want to get in touch with Josh, there's a link scrolling at the bottom there that will connect you. So I'll leave that question in there for Jennifer. Liz says, any discussion about paying cash for $1 million house and this time of the market? So I don't know what you're exactly referring to there, but what I can tell you is, as I mentioned a moment ago, my clients just lost out on a $1.25 million property because the other buyer had cash. So we were essentially the same price. We had a loan, 20% down, actually 25% down. They had a cash offer. They chose cash offer. And honestly, you can't get mad at that, right? I mean, that's just what you're dealing with. So there's still cash out there in the market. It's all about finding the right property. Bebo lives in LA for 2 years looking for a house in Huntington, Cypress, Cerritos, West Garden Grove. Please advise, what is your recommendation from the best to the okay for these areas? Too much to do here. You can email me. There's actually a link I'll put up on it's on my website, but I'll throw it up here in just a minute, where if you want to have consultation, we can talk in more detail. But you can email me as well, and we can have that conversation. But most of these markets are relatively safe, good areas. There's pockets in them that you might not want to be, depending on what you're looking at. But prices are less in those areas. So 900 to $1 million is going to cut you out of part of these markets, depending on what you're looking for. And these are things we can discuss in more detail. So let me know. James, what's the time frame to apply for an FHA loan after a Chapter 7 bankruptcy? So Josh, after Chapter 7, what is the time frame with
2
FHA?
years, 2 years FHA, 4 years conventional, unless we have some extenuating circumstances, which would be something along the lines of death of a spouse, something along those lines. It would be pretty significant to be able to consider it extenuating, especially since FHA only requires a 2-year waiting period.
There you go. Good stuff. Question, is it worth waiting until the fall of 2023? Irish in USA. So difficult question, right? We have no idea. That's a year and a couple of months from now. It's tough to say what the market looks like at that time, what interest rates look like at that time. What are you waiting for? I guess that's the big question is are you waiting for lower prices? Are you waiting for, to save more money? Or like, what is it that you're trying to accomplish by waiting? It's difficult to answer that question. What I can say is that, through this year, through the fall, you're likely to see some more inventory out there, right? Some more properties to choose from. It's difficult to say where interest rates are going to be, and how that's going to affect buyer demand as we continue forward. So there's a lot of unknowns. Unfortunately, too difficult to answer at this point. Josh, anything you want to add on that one?
Well, let's revisit this answer to the question from the last 2 years. So generally, when people say, hey, I'm going to wait, the thought then was, well, I only have $10,000, and to get my 3 or 5% down payment and closing costs, I need $30,000. So we would run the numbers and say, listen, if home prices go up 5%, you're looking at a $500,000 house. That's $25,000. So homes were going up faster than you could save. Now, what do we think is the likely trajectory for the next year? Depends on who you talk to. Like if you look at CoreLogic, you look at Redfin's numbers, you look at Zillow, in most markets, they're still projecting 7 to 10% increases over the next year. It's gonna be hard to see that, but that's what they're throwing out there. Now, if we get something between 0 and 5%, which, that's probably, that's a nice blanket to throw over what's likely to happen. Now, if we're in the 1 to 2% range and you're saving money and it puts you to a better position, there's not as much of a disincentive to wait. The other thing being, depends on what you think is going to happen with interest rates. We get people here in the comments every week that say, just wait, I read an article, they're going to 8.5 to 10% just by the end of the year. If you think that, the monthly payment will be significantly more expensive. If you look at it and you think, hey, we peaked somewhere in the high 5, low 6 range, and we're likely in the next 6 to 24 months get back to the 4% plus or minus range, you could benefit with a lower payment, even at a slightly higher price point. The problem is none of us have crystal balls, not even Jeb. And so we sit here and say, what's the most likely outcome? A year ago, 2 years ago, it was super easy to say, you probably just need to go before you're comfortable, just because things were moving so quickly. Now, if you're not certain and you want to deliberate a little more, it's not as likely to be painful as it was a year or two ago.
There you go. Good advice. So two people have this question. We got Andrew 1059, and then we also had Michelle asking the same question. So we're gonna go with Andrew since he was the one who originally asked it here. Said, what do y'all suggest to a first-time home buyer to buy or wait because prices might get better? Actually, that's not necessarily the same question, but she just says, I'm in New Jersey and these new home builders are charging 800,000 to 900,000. So
it's the same question. She's saying,
it
do I
is the
buy
same
in
question.
now,
Yeah.
or do
So
I wait for
buy
a
or
builder
wait.
to
So
come down?
Josh kind of just answered this. By waiting, what are you getting? Are you getting a lower price? Are you getting better options? Are you getting a higher rate, a lower? Like, there's too many things to figure out. There's too many buyers out there trying to pick the perfect time to buy a house versus just going when it's the best time in their life to do it. And I realize that is easy for me to say, being on the side that I'm on, but the reality is too many people are worried about the price of their property tomorrow versus just wondering, can I afford it? Does it make sense for my family to move in this location? Is this the type of property that we're going to need for the next 10 or so years? Do I have extra money in the bank? Outside of my down payment, do I have reserves? Am I comfortable? Is my job secure? All of these things. And some of them obviously are somewhat unknowns. But those are the things you should be thinking about, if you can afford it. Now, if you can't afford it and you're hoping for lower prices, then I guess if you can't afford it, you can't afford it. Then you either have to make a decision to buy something less than what it is you're looking at, move to a different area, and or wait and cross your fingers and hope that it comes down. Now, the new construction question is an interesting one because I think in some markets there might be an opportunity to get some incentives, perhaps get a property less, significantly less. I don't know. But if you have a builder that's overbuilt in some of these areas, there might be an opportunity to get a property for less than the asking price, maybe a couple percent less than the asking price. It's all going to depend on different markets. Now, you can't just look at an area and say, well, $900,000 homes are just too expensive, I can't afford them. Should I wait? Josh and I can't answer that question. There's just too much going into it. Josh,
So
what do you want to add to that?
I would just go back to the math of what you were talking about, the right time in someone's life. I believe that over a lifetime, everyone should own a home, and you should buy that home as soon as is the right point in your life. So those elements, what's the math behind that? Why is sooner better than later? You're paying down in principal. You're going to get appreciation over the long haul. We don't know what that's going to look like in the next 12, 24, 36 months. I don't believe it's going to go negative. I don't believe it's going to be hugely positive. But just if we look at a 30-year mortgage, and our goal should be to arrive at retirement or later on in our lives with household or financial freedom through our house of just having to pay for our property taxes and our homeowners insurance. The sooner you can get that working in your favor, the better. So again, without a crystal ball of not knowing what exactly is going to happen, the risks of waiting are not nearly as bad as they were. But there's still some risk and uncertainty there. You have to just decide, where am I in my life and how important is it to me to own a home? And am I comfortable with it maybe not ending up being the optimal time? Jeb, we have sort of a follow-up. I think it's kind of a corollary question here. Sandeep asked, and we get this one, probably every other show. Would you rather buy with high prices and low rates, or low prices and high rates? Which one is better? Well, it's an easy one. You would want as low a price as possible with a higher interest rate, because the rate is not permanent. The price is. The price never changes once you pay it. So that being said, we don't know what is going to happen going forward. I believe interest rates are going to be lower. So you would be buying right now at a high price point or a high interest rate, but you're also buying at a high price point. So I talk to people all day, every day. Everyone wants to push this narrative that no one wants to buy. It's a terrible market. We're heading for a crash. Look at, there's more inventory. And when you dig into it, it's not the story the numbers are telling. My phone rings every day. I have 3 to 5 people every day that want to talk about buying a home. Does that mean they're all going to buy a home? No. And largely that's because of where interest rates are and where home prices are. If prices were lower, if we had a time machine back to 2018, probably 80% of the people that I talk to on a daily basis would be ready to buy a home, but a lot of them can't. So again, exactly what Jeb said, the right time in your life, judge where you are, that you're going to be able to be there for an extended period of time. And if you're able to qualify and buy a home you'd be happy with.
There you go. And then Select Hunts also came on and said our new build's suffering right now. I think we kind of addressed that a little bit, but I think in some markets, builders are, they've overbuilt homes and maybe, especially if a builder is building multiple communities at once, are they in trouble? It's hard to say, right? Some might be. I talked to a buddy recently who's in Florida. They have a division in Florida, they have one in Arizona, they have one in Southern California, and he basically said, listen, it's slowed down, but we're still selling houses. It's not like nobody's coming in. There are still people here to buy properties. It's just not what it was a year ago. And I think if you are using any logic, and you have an idea, yeah, the market is slowed, but that doesn't mean that it's changing entirely. We're just getting back to more normal times, and everybody has that that short-term memory, and all they remember is what's happened recently. Well, the last 2 years historically is not what happens in the market generally, right? We saw craziness for 2 years, and that's what everybody remembers. 2019 was a solid year in the real estate market. In fact, 2020 started out to be a pretty good year. And then the craziness ensued and what have you. But back then, we still had low inventory. We still had buyer demand. Interest rates were, less than they are now, but they were quite a bit higher than the lows that we saw. And the market continued to move forward. So again, it all comes down to the right time in your life. But new construction, some markets might be suffering a little bit, some others not. Just again, it's local. Talk to a pro that knows the area, get some advice. And if you need somebody, there's a link below. All right, Josh, we got, let's see here. You answered this one too, from Christian by answering the question a moment ago. But Emilio says, I've been hearing about real estate crashes for the past 5 years. I'll believe it when I see it. So at one point we posted a clip from CNBC's finest, Diana Olick, where it's a clip we stole from someone else, Barry Habib, but it shows her coming on on TV, on live TV, and basically talking about a crash, the market stalling, and I think it goes back to 2015, 2014. So 2014, every year at some point in the year, she's called a crash. And now here we are 7-8 years later, and we're still talking about the same thing. So you can actually go back and pull articles every year, just like you can with the stock market or anything else, how everything's going to crash. There's always people on both sides of it. Read between the lines, people. And again, do what's right for you, right? None of this matters as long as you're doing the right thing for you.
Jeb, that comment there leads to a question here. So Andrew 1059 back with question number 2 for tonight. Based on the Fed, inflation, etc., will the next 20% move be up or down in housing? Will the move be more or less than 20%? So I like the follow-up question. The first one's interesting. Everyone likes to think in terms of that. So let me start, and then you throw your 2 cents in, Jeb. The easy answer is markets are far more likely to go up 20% than they are to correct. When I say markets, housing markets, if we're talking about stocks or even bonds, those are much more volatile, more liquid, easier to get out of. You can see a stock lose 20% in a month. That doesn't happen in housing. We've talked about why home prices are sticky to the upside. I wouldn't expect a 20% crash to happen, and I wouldn't expect another 20% appreciation to happen soon. Like, again, when we say 0 to 5, my guess would be we see 2 to 5% appreciation for the next 4 to 5 years. So if it's 2%, you're talking 8, 9 years before you got 20% cumulative appreciation. If it's 5%, it's 3 years. So that's still a pretty wide range when I say a narrow range of 2 to 5% appreciation. So my guess with the move is going to be less than 20%. If it comes down, if prices did drop in most markets, it's going to be less than 20%, but it's a possibility.
Yeah, I mean, I don't really have much to add on to that. I mean, I definitely think the move, up or down is less than 20% for the foreseeable future, right? I think you see more sideways movement, and with that, some markets might drop 5%, 10%. Some might not drop at all, and that's going to depend on where you are, and you know, inventory levels and a lot that's going on there. But I think more like we've talked about deceleration in the market, just not the appreciation that we've seen. Now, I've seen a slowdown, and I think homes could sell for, less than they're selling for now. Yeah, sure. Does that mean they're down 5%? I don't know. In some markets, maybe. Josh doesn't think we're going to see it. It's hard to say. I think
it's not outside of the realm of possibility. I don't say
no,
it's an
I
insane
don't think a
thought.
20% decline is realistic in most markets. Could it happen in some? Sure, it could. If you're completely saturated with new construction, you've overbuilt in some pockets, absolutely that could happen. But for the majority, like a Southern California, you're not going to see big drops like that, in my opinion, just because of the lack of available inventory. Even though inventory is picked up, it's still well below, historical measures, and even going back to 27 through 2019 here locally. At this time of year, we would have about 6,700 properties on the market. Today, we have 4,000. So it's and inventory is going to build a little bit further, but it's gonna at some point this year, it's gonna reach its peak and it's gonna start to decline as we move through the fall winter market. It does every year, well, not every year, but when you take in that seasonal effect, and we're getting back to more normal market where the seasons are actually going to start to have, a play on the direction of what we see out there, as things normalize. So hopefully that's helpful. All right, Josh, let's see here. David said he was throwing no shade on me. Just wanted to acknowledge how difficult these weekly shows are. I appreciate it, David. Your questions can now be answered once again. You've redeemed yourself.
You threatened him into rescinding his commentary. I see how you work.
Back against the wall there for that one, but I will allow it. No, appreciate it, David. Let's see here. We got a couple. All right, we'll just go here. So Jennifer says, on average, how much should one save for the closing cost for a home that's about $600,000 to $700,000? Goal is to get a conventional loan with 3.5% down. So saving for the down, is there a way to figure out before? So on average, what do you think you need in addition to your down payment in order to be able to buy a house, Josh?
Now remember, we're California biased, so we step into it every time when we answer this. Depending on whether you're impounding for taxes and insurance. So remember, we have closing costs, and then we have your prepaid items. So you're going to pay your first year's homeowner's insurance. You're going to pay some prepaid interest on your mortgage. You're going to pay some prepaid taxes on there. So from that perspective, generally about 2%. It could be slightly below that, but not much below that. Could be as high as 2.5%, 3%. And now this is the part of the show where our New Yorker visitors pipe in and say, I paid 5.5%. It can be in certain parts of the country 3 to 5%. So what I would say, never too early to talk to a lender to go through this with you in your area, in your market. I talk to California buyers all the time, and we go through this. Say, hey, we got to get the kids back in school in August. It's probably going to be October, about Halloween, before we're looking. But We want to see where we need to be. They say, I got this much money, and we can run through the numbers. We know what type of loan they're going to get, what they're going to put down, and we know what the impound setup is going to look like at the time that they're looking at buying. So never too early to talk to a lender. I always get this one. People say, well, I don't want to waste your time. I'm not ready to buy. Never a waste of my time to educate someone who's going to come back later and potentially buy a home. And even if they don't, helping you get the information that you need to buy that decision or make that decision should be a part of the lender's job, even if it's 3, 6, 12, 24 months before you're actually ready to buy.
Good stuff. And then we have a couple people in here asking questions specifically about rates. What he said, Jessica went on to ask about how long do interest rates stay the same, change? Do they change monthly or daily? And then we had Jennifer actually come in here and say, when comparing lenders, get your quotes on the same day. Several days or a week apart is apples to oranges. So here's the thing. Actually did a video that'll be posted on Friday about shopping lenders, what you should do, what you should take into account when shopping lenders, what the process is to shop lenders, what you should look at, the conversation you need to have, or what you should think about when picking your lender. So make sure you watch that on Friday. It's going to dive into it in detail, but Jennifer did touch on something very important there. And yes, interest rates change hourly. They can change, a couple times in an hour, depending on, what news comes out and the volatility in the market. So just make sure, again, you're talking to a pro, and use that link below if you need somebody. So that'll get you to them. Let's see here. Josh BP says San Diego inventory is up now. Where do you guys see the market from here? Riverside County home started to get, price cuts. Also, should we continue to skip contingencies? So let's start with the last question first. I think less of the skipping contingencies out there. You should never skip the home inspection, just so you know. But appraisals and that sort of thing, I'm seeing less of the skipping in this market because you're not having to do the craziness. Now, if you're in a multiple offer situation, maybe you might have to consider something like that, but I'm seeing less of it in this market, less people doing that. So I think that's, not gone completely, but just it's more normalizing with regards to how offers are being written, right? It's less of a seller's market now, right? Buyers have gained some control back, and therefore they've gained some of these items that they were having to do in order to get their offer accepted back. So, second part of the question, or first part of the question rather, is inventory's up. Where do you guys see the market from here? I think you might see prices move down a little bit, but not by much. When looking at comps, you can't compare a house today to one that sold back in February, right? Interest rates were, that home that sold in February went into escrow in January, December, January, when rates were quite a bit lower, right? So a home today compared to that it's like apples to oranges. So just make sure when you're looking at the market, you're looking at real estate, and you're taking this into account. Like I had a client reach out to me today and send me a couple of properties around 1.5 million. Their budget is around 1.25, right? I don't see those 1.5 properties becoming 1.25 again, in that particular area at the moment, based on what's going out there. So prices will likely moderate. You'll likely see some, homes sell for less than they're listed for. I think that's going to be the norm. But days on the market are going to build and going to continue to build as you move into a slower time of the year. That doesn't mean the world's crashing, guys. It just means it's a slower market. It's more normalizing. We're getting back to, times before the craziness, and that's okay. So,
and think about the current market may be a harder time to come to terms with a seller, because sellers are adjusting and trying to figure out, what does this market look like? What does this mean? Just as recently as 6 months ago in January, their expectation is put a sign in the yard at any price and there's going to be a bidding war. I'm going to basically have an auction for my house. The cool thing about that is the market is telling them what the value of the home is. Right now, if you put a sign in the yard and you overprice it, you might have no showings and no offers. If you put it in at the right price, you're going to get a handful of offers. So they're kind of feeling out and seeing what that is. I have a client who put in an offer this week in Laverne. It's a $1.2 million property. They offered 1.1. Is that insulting? No. And talking to the agent, he thinks it might be the right number for the house. It's very dated relative to the homes in the neighborhood that are selling for 1.2. But those sellers just are not ready to accept that their home is not worth within $100,000 of their neighbors. So it's going to be an interesting time. Now, in regards to San Diego and Riverside, where you talked about, San Diego is now very similar to Orange and LA counties. The prices have come much more in line with that, and you have more established communities. Riverside can be all over the place, but one of the things that you want to look at, we talked about, are we likely to see home price drops? The areas most at risk of of dropping home values are areas with a high percentage of first-time buyers, and that's not because first-time buyers are bad. It's because they generally are putting smaller down payments and have a weaker financial condition in terms of reserves, all of that fun stuff. So when you look at an area like Riverside County, they do have a much higher percentage of FHA loans and minimum down conventional loans. So there would be more risk there than there would be in older, more established areas and higher prices. So doesn't make it a bad area, doesn't mean it's going to crash, but there's probably a little more risk there than other areas.
No, good stuff. Good stuff. Determinator says, does it make sense to get quotes from various lenders before the seller accepts your offer? Yeah, I talk about this again specifically in that video that posted on Friday about shopping lenders. So check it out. But yeah, you're going to talk to multiple lenders. I talk about how to do that. And then you might actually talk to them again once your offer gets accepted, just to kind of update those numbers and see where you're at. So hopefully that is helpful for you.
So hold on, Jeb.
Yep.
We've had this is I always want to give helpful information with this, and I am not sure how helpful any information is. People ask, well, how do you shop? What do I need to be asking these people? And we have another question in here saying, hey, what are the things that I need to be asking? Actually, it's just
We're
follow
just
up
going
here.
to push them off to the video on Friday.
So Jessica Ochoa says, how do you avoid a predatory loan with your lender? Is there something to look out for? Look forward to all your videos. I've learned so much. So when looking at this, I've had a couple of conversations. So I had a gentleman last week we talked to, and he's already talked to 2 lenders. I'm the 3rd lender. That's not common. Most people don't shop 3 lenders. I think the number is like 74 or 75% of people will go with the first lender that they talk to. So he gives me the parameters and he tells me, well, I've got this lender is offering me this, and this lender is offering me this. He says, well, why are we talking? That lender is offering really good terms. And it was a jumbo loan. If it had been in Southern California, we could have done better than that. Where he was in the Bay Area, we couldn't. It didn't have, my lender doesn't lend there. So we look at it, he's like, okay, you're right. That does make sense. Calls me 2 days later, sends over the loan estimate. Oh, when they sent the file over to the lender wasn't comfortable with it. And I go, well, it's less likely that the lender wasn't comfortable with it than that it wasn't there to begin with. And the guy thought, hey, he'll get you to apply, he'll get it to come in, he'll go, oh, we can't do that, but we can do this. So he ends up doing worse terms than what I verbally told him we could do. The guy also says, well, my realtor also does loans, and she says she'll do the loan at no cost to me, just as a service to me to do the loans. And I said, why would someone offer to do the loan for you when you have another lender? If they're not making any money, they wouldn't do that. So what I'm saying is when I'm asking them, what are the people telling you? There's just certain cues and tips of where we're at. And sure enough, he sends over the loan estimate that his realtor sends him, and she's making money. And she tells him in a very specific way how she's not making money, but she was making like $7,000 on it. So it was a cheap loan, but again, we could have beat those terms. So did this person do anything wrong? No, he talked to 3 lenders. He went with the one that offered him the best terms. Then he had to back out because they changed. And then he went with his realtor who told him she's not making any money, but she's actually making money. I think it's important that you check and make sure you're getting good terms, but the people that call me back, like this gentleman did, that we have conversation after conversation and headache and heartache for 2, 3, 4 weeks while they're trying to close their loan, are the ones that call 3 lenders. And instead of saying, hey, I had a great conversation with this person, they heard me, they educated me, they gave me honest, accurate numbers up front versus some sort of verbal quote that they don't deliver on. The people that call me back are the ones that call around, and whoever tells them the lowest number, they go with them. You wouldn't go to Nordstrom and expect to pay the same prices as Walmart. When you're getting these low quotes, generally, I won't say always, it's from someone who is not going to give you those levels of service. Jeb and I talk about this all the time. real estate and mortgage are absolutely 80-20 industries. 80% of the people you would not want to work with or have anyone in your family work with. Thankfully, there's enough mortgage people and enough real estate people in that 20% that you have options, you have choices. Just please do not go to the lowest bidder. You will get lowest bidder results. Someone needs to be competitive and in the ballpark. But I had a conversation yesterday with a gentleman who came from Kyle's channel, and I think he goes, "Oh, I've got to figure that's about $700 lower." I said, "Okay, in the grand scheme of things, on a $600,000 purchase, $700 isn't a lot. Why did you call me after having this pretty darn good quote that you thought was good?" "Well, she did this. She didn't give me accurate numbers. She told me she couldn't quote me fees until we had an accepted contract." So I guess long answer, Jeb, is like trust your gut. If someone
This
doesn't
is
seem
the
to be
long answer.
if someone doesn't seem to be forthcoming and giving you honest, accurate answers, trust your gut. I like to give people a good answer to this, but I see people all the time and talk to people who've painted themselves into corners because they shopped and went for the lowest price.
All right, there you have it from a lender. Now, good stuff. Yeah, but again, like I said, it doesn't hurt to talk to multiple people. Just know what you're getting into. Like Josh said, it's the lowest guy is not always the best lender. And I talk about that in that video that I mentioned. It'll be posted on Friday. So been on an hour. Like to ask a favor, if you would be so kind as to hit that little thumb down below the video and show us that you find value in the content, that you appreciate us being here. 2 hours of our night to bring you education, to guide you through the process, and help you become better educated home buyers. So we appreciate that. We're 84 thumbs ups right now. Josh, by this time last week, I probably had 150.
6,000,
I don't even
7,000
remember.
or
It
so.
was so many that I lost count. Even though the number was there, I lost count.
I heard that you retired off of all the super chats from last week, and you don't even sell houses anymore.
Amazing. No, in all reality, we appreciate you guys being here. Let's see what we got. So this is something, Josh, that we've talked about a little bit. If a recession is announced next year, will that prompt the Fed to lower the interest rates? So let's talk about it. Earlier, you mentioned that the forecast, if you will, not the forecast, but the Fed survey shows that the poll that they run shows that the majority of traders out there think there'll be a 25% basis cut by this time next year, something along those lines.
June of next year. So yeah, in the next 12 months.
So understand the Fed doesn't directly control interest rates, but when the Fed, when the economy typically slows, they need to stimulate the economy, provide growth to the economy. How do they do that? Well, they can do it one of a couple of ways. They can lower the Fed funds rate, or they can start to, again, buy mortgage-backed securities, bonds like they did in the past. And if the economy does stall, Josh, do you think the Fed will lower the Fed funds rate, which in turn could allow interest rates to move lower?
They absolutely will. And in terms of mortgage rates, again, that's not going to be a leading indicator. You saw rates going up in January, February, March, well before the Fed got serious about raising interest rates. If anything, the Fed was behind the markets in that, and they'll be behind the markets on the way down also. They want to give themselves some wiggle room, so they're going to keep raising as long as they can make a case that the economy can withstand it. So if you look at the projections, what is the expectation, Jeb? Another 1.5 through the rest of the year? So 75 at the next meeting, and then probably a quarter at the last 3 meetings for a
total. Where are we at?
175
now?
I believe so.
I have no idea.
It's hard keeping track when they jump them 75 at a whack, but
I think we're 1.15 to 1.75 somewhere in there. Yeah.
When you look at that, when you see Treasury yields decreasing, which they seem to have peaked and have settled in, like we said at the top of the show, between 3 and 3.1. When you see Treasury yields at 2.75, at 2.5, that's the market telling you this is the return required to tie up money for 10 years based off of inflation expectations. So we've talked about this before. Recessions are by definition deflationary. So it really should be disinflationary, so less inflationary than where we're at right now. The biggest issue that we have right now is that the cost of energy, fuel prices are our biggest problem, and that's not just a problem for us in the U.S. It's everywhere in the world. Our friends in Germany shut down all their nuclear energy. Our friends in France, they're having a heat wave. They had to shut down involuntarily their nuclear energy because the river water was too warm to cool their reactors. So I don't know. I think inflation is going to remain elevated longer than we would like, but rates should moderate somewhat from here as it gets more under control. Inflation gets more under control.
Now, when you say inflation remaining quote unquote higher or a problem, are you talking? I know I already know the answer, but I'm asking for the public here, for the viewers. Are you talking we're going to continue to see 9% CPI numbers, or are we going to see higher than the 2 to 3% that the Fed wants to see?
We've talked before on the show that you can kind of reverse engineer the next 2, 3, 4 months of reads on CPI, and we're probably going to have another hot one here in August. The reason why the hot one in July that was even hotter than June didn't precipitate the same reaction is for some reason markets thought June was going to improve and it got worse. Now they're expecting August to be good for some reason. I don't know if you saw the headlines, Jeb, after last week's numbers. A lot of things, hey, that should be the end of it. We should start seeing slight improvements in reading. So where does that lead to? Your question is, what is normal and what does it moderate to? In the near term future, you'd love to see that under 5%, and near term, it would probably take 6 or 7 months to get out there. So let's see where we are when we roll over the calendar into 2023 and what that does for interest rates.
Good stuff. All right. So, what do we got here? We've got Jacqueline becoming a member of the show. Thank you, Jacqueline. I appreciate you. I did. We chatted back and forth via text. She was in the area, reached out to me, and didn't work out, but maybe next time. Let's see here. I had an easy one, Josh. Michael De La Torre says, what documentation info should we have when talking to a lender? So I'm having my initial conversation with a lender today. Should I have my pay stubs, my tax returns, my bank statements, all of that on the initial conversation, or is that information that I'm, to gather after that initial conversation?
So my preference is to have a conversation up front before we look at any of that documentation. And we're going to go through and say, Michael, is it just you, or are you going to have a co-borrower, whether that's a spouse, a family member, whatever that is? Okay, are you self-employed or do you work for someone else? Are you paid by the hour as the salary? Do you have any variable income? So long way of saying, we're going to go through that, and we can do, and Jeb, we've talked about this before, there's between a pre-qual and a pre-approval. Basically going to do a pre-qual over the phone to see if you're in the ballpark. If you say, hey, I'm wanting to look at homes in the $500,000 price range, and you're telling me you need the payment to be under $1,500 because you only make $4,000 a month, we're going to have a conversation about that. But in terms of documentation, once we have that conversation, now I know exactly what documentation we need. We'll send you a link to the portal where you can complete the application and upload the supporting documentation. So for an employed person who works for someone else, pay stubs and W-2s. Conventional loans generally only need the most recent year's W-2s. FHA and VA will require 2 years. If you're self-employed, if you own rental income, if we have like dividend income, that type of stuff, we may need tax returns, and it could be 1 or 2 years. So you're starting to see why I like to have the conversation up front. We can have a pretty solid idea once we get off that call of exactly what we're needing and not have to ask you for more than what is required. And on top of that, you're going to want the statements for the accounts for the last couple months where your down payment and closing cost funds are coming from. We'll need photo ID, but it doesn't really come into being able to tell you what you qualify for. Now, that being said, I've got friends in the business that they want to send you the link to the application to get that documentation up front before they even talk. So there's not a right or a wrong answer. It just comes down to what your preference is. My preference is to know what we're asking for before we ask for it.
Good stuff. Now I'm going to throw you a couple softballs here, Josh. Should be pretty easy to answer these. Could I roll over closing costs into a mortgage with FHA?
No, on a purchase, you can never roll the closing costs into the loan. The reason for this is you'd be
unless
increasing.
It's USDA, potentially.
Bingo. Jeb's strong on his USDA game. He's got videos on it in case you guys are interested in USDA loans. So correct. So anything other than a USDA loan, which still, as Jeb was saying, would require a higher than purchase price appraisal, But the reason why you can't do that is because, say, on an FHA loan, it requires a 3.5% down. If you had 2% closing costs and we rolled those into the loan, well, now you only made a 1.5% down payment. You don't meet the requirements there. You can do it on a refinance because that loan is based off of the equity in the home, and hopefully you've already had enough appreciation into the property. So it's important to know that there are ways to cover those costs. You can take a slightly higher interest rate and get a lender credit to cover those costs. We're starting to see in this market, Jeb and I just did an episode of the podcast talking about seller credits, something that was totally unheard of 6, 8, 9, 10 months ago. And we're seeing loans, especially in FHA markets, where sellers are covering a portion of the closing costs. So there's ways to cover it without it coming out of your pocket, but you can't put it into the loan.
Good stuff. We got some different questions here that we're going to knock out real quick in a moment. But Josh, here's another easy one. Mark says, I'm a new landlord in an owner-occupied duplex. So he lives on one side, leases the other. I want to buy another property, but the bank says I need 2 years of rental income on tax returns. Projected rents don't work, ? Been here for a year. So Josh, how is a lender looking at the rents on that property now that he lives in it?
So with it being a duplex, if you've been in there for a year, so it puts us to last July, we should have 6 months of rents for the other unit that is rented out. For the owner occupied unit, we should be able to give you 75% of the projected rents. They'll make us get a market rent survey. Hedge my bets here a little bit because it varies whether we're doing a conventional loan, whether we're doing an FHA loan. If we're talking about a duplex, the lowest down option is FHA, but you really need to talk to a lender to learn a little bit more about your situation to know exactly what we could do. So depending on where you're at, if you're here in California, reach out. If it's in one of the other 49, Jeb's got you covered.
Yeah, there's a link scrolling the bottom there to get you connected. Let's see here. I'll answer this one real quick. Urel says, what's future prediction on the housing market in Atlanta? I don't have one. Don't know Atlanta well enough. What I can say in talking to people that sell, real estate in Atlanta is that it's still moving, slowed down. If you saw home prices, I know that Atlanta has a lot of first-time home buyers using FHA loans. I've seen the data before. So if you see a market that moves sideways and possibly decline in prices, maybe that market, those FHA loans affect the market there. But for the most part, still a strong market. I don't really have a lot of information for you. If you need a pro there, again, just click on that link below, and I'm happy to put you in touch with somebody. Michael is coming back with some really good comments here that I thought I would post on the screen and read them for those of you who are watching. It says the Fed will overcorrect the same way someone slams on the brakes at a stoplight. They will gradually lower rates as CPI starts to lower month by month. But when that happens is anyone's guess. So I think there's a lot of truth to that. But then he also says the biggest variable is going to be unemployment. If it stays low, rates might stay higher for a while. I agree with that as well. The Fed has two jobs. One of them is employment. And employment numbers, that's the only reason we're not in a recession, is employment has remained strong. So that's what's giving them the opportunity to do some of these aggressive rate hikes. If employment starts to become an issue, they're going to be a little bit more cautious on this stuff, and that could allow rates to moderate a little bit quicker. So hopefully, well, I'm not sure if that's helpful or not, but I thought it was good info, so I wanted to put it out there. Henry says, what is the most common percent amount put in escrow for deposit on a used home? We're going to use existing instead of used. And why? So
that's realtor speak, Jeb. We don't want to hear realtor speak. It's a used home. He's 100% correct. It's a used home.
This is going to vary by state. I've recently learned that some states not only have a deposit that goes into escrow, but they also have a deposit that essentially goes to the seller that's not refundable. If you back out, that money's gone. Whereas here in the state of California, it just goes into an escrow account, and at which point you have contingencies, it's safe. Here in California, in this market, it's around 3% of the purchase price. Some states, it's not even a full 1%. It might be $1,000 on a property. So it's going to vary by location, by area. Talking to a pro in that market, they should be able to guide you on what the market does there. But I would say it's it's somewhere between 1% and probably 3% for the most part.
And
Again, it just
Jeb,
depends on where you're located.
for
Yep.
the most part, I mean, there's 100%. There's nothing required. It's whatever the
No,
seller and the
absolutely.
buyer agree to. But that's also an
Good point.
element of the negotiations, right?
Yep.
If you want to strengthen your offer, you're gonna offer a bigger deposit than a lesser deposit, or can be one of the things you consider.
Yeah, absolutely. I mean, you got to think of it. If the money is not at risk, well, this could get in, we could deep dive into this, but at the end of the day, if you're going to be putting that money down towards the down payment, the closing cost anyway, and you feel confident about the property and releasing your contingencies, then I think you go in with a strong deposit, assuming you have the money to do it. Now, if your market doesn't require it, then why put the money at risk? So again, it goes back to following kind of what the market's doing in your area and how competitive you need to be in presenting your offer. All right. Sandeep says, is it wise to lock rates? We are looking at a 7 or 10-1 ARM at this point for new home construction. So I don't know how far Sandeep is out. But Josh, if you're looking at a property, I mean, let's go with this one. Just Will has a similar question. It says, put in an offer on a new construction spec home. I have a home to sell. Should I lock in for 30 or 60 days? I have a 5.6 rate in Northwest. I have no area. I have no idea what the I is
Illinois,
there.
Indiana.
Yeah. Thanks. So you could apply that. So a 30-year fixed, an ARM, should you lock a rate being 30, 60 days out?
I would say for the most part, yes. If you go back to our interest rate discussion at the top of the show, the reason being is there's not a compelling reason for rates to drop a considerable amount. And when they pop up much faster than they come down. So risk versus reward, it's almost a coin toss as to what happens next, either rates coming down or going up. But if they go up, they're going to go up faster. And for most people, they can deal with lost opportunity more than they can with actually losing money. So I would say lock if we're talking on new construction like Sandeep, 180 days out, find out what the terms are. If the lock makes it egregiously expensive, maybe not. But I know builders are getting aggressive on covering the costs on some of these long locks to lock people in with their lender. I had a client who we have pre-approved who was talking to the builder's lender. She's got a 180-day lock at a rate an eighth lower than we can do today. That's subsidized by the builder. So you guys with new construction, you want to talk to the builder's lender. I could tell you bad things about them, but there's a way to leverage this in your favor in this game. Builders want control, and they realize that there's some pressure on their prices right now, and a way to keep control and keep people in the game is to offer subsidized financing. So with both of those, just see what the options are. For Will here, 30 or 60 days, Jeb, I would probably lean more towards 60. It would be tough to get a home on the market in escrow, closed, and money available for the next home, especially with the market moderating a little bit.
No, and he goes on to say he's in Northwest Indiana. And then comes up with a follow-up. I'm kind of anxious that my home won't sell in 30 days. It's a 3-year-old townhome. So that's a reasonable concern. It depends on when you need to, when you got to get it sold. So that's the conversation you need to start having now. And maybe you sell it and you have an opportunity to rent back, or you sell it and you have, you negotiate a longer term escrow or whatever it is. That way you just get it under contract so that you don't have to worry about pulling the trigger and having a concurrent close on both properties, because that's a little bit more difficult, especially in a market that is changing a little bit. So hopefully that's helpful for you. Kara vlogs. Do you know anything about the housing market in Central Arkansas? I do not, unfortunately. But I can point you to somebody if you need it. Unfortunately, I'm not your guy. Alfredo, is there a grace period after the loan contingency due date? So in the state of California, it depends. The easy, simple answer is no, right? So if you have a 10-day contingency period to release, well, let's just go with the contract. The contract says 17 days to release contingencies. So it's day 17, you're supposed to release those contingencies. But, the contract also gives you, or gives the seller, an opportunity to send you a notice to perform. The way the contract's written is they have 48 hours once they send you that notice to perform, at which point you don't respond to their request, they can cancel. So I've had agents, listing agents before, send me that notice to perform 2 days before 48 hours before my contingency removal was due. Therefore, the notice to perform and my contingency timeframe expired at the same time. Therefore, no grace period. In most common circumstances, cases, agents don't send a notice to perform until you don't follow protocol or don't adhere to the contract and release on, say, day 17, at which point, they send a notice to perform at that point. So that grace period could be 2 days. But what I'll tell you is most agents are reasonable. Most agents are fair when communication is open. So if you've got a timeline that you're not able to abide by for one reason or another, but you're open and having conversations about it up front prior to, the hour that it's supposed to be released, people are more receptive and willing to work with you in those cases. So I would say, is there a set grace period? No. Could you get one? Sure. So it's all going to depend. And different markets are different, right? Here in the state of California, that's the way we do things here. I'm not sure how it works in other states.
And just to give a little context to it, after we get off the show tonight, I have to call an agent. It's a client that we did a refinance for, I believe from the show earlier this year. Went to buy a new home here, and the realtor wanted them to go with her lender. And a week ago, I get a call saying, hey, their lender can't do the loan. And we go through it, and we're like, I don't know why. We just did the refinance for you 3 months ago. We look at it, and it all makes sense. So the contingency periods were up last Thursday. I had to call the listing agent and say, hey, I just got the deal. I think we're good. We can't release the contingency till I have a loan approval. Well, our loan approval came in today, and there's a couple of dicey conditions that we're going to have to ask him till Friday. So because we've been having that communication, telling him exactly where we're at, exactly what we're dealing with, he and his seller have chosen to be forgiving and give us some additional time and not give us that notice to perform. But at any time, they could.
No, absolutely. And that's communication. Communication is key. So, earlier we talked about shopping for a loan, shopping for an interest rate. One of those things when choosing the best, the lowest interest rate, if you will, oftentimes you're going to be getting somebody in a call center that can't have these conversations, that can't do the legwork, the communication necessary in order to get you to the finish line, right? So the best rate out there means nothing if your loan doesn't close. So go with somebody that's competitive, but also goes with somebody that's that can communicate and educate you through that process. It's really, really important. I can't tell you how many deals fall apart because the idiot on the other side has no idea what they're doing and can't communicate, anything to the, other parties. And honestly, over the last 2 years, it's been pretty easy because deals have been flying in. It's going to be less of that, right? The market's going to get a little bit more competitive with regards to the mortgage pros out there. There's going to be a lot of people dropping out of the business because the refi business is gone. So, again, that link below will get you to somebody who knows what they're doing. Josh, let's see. This is a good question. We haven't had this one before. Do you think existing home sales could fall below 4 or 3 million this year or next? So let's provide a little bit of context. Last 2 years or so, we've sold around 6 million homes. This year, they're projected to be 5.1, 5.2 million, 5.4, somewhere between 5 million and 5.4. I don't know what the latest estimate is. Do you see a market where we're selling 3 or 4 million homes per year?
Well, considering that in the worst of the downturn, the Great Recession that was led by housing and caused by housing, we were at about 3.5. And that actually was 2012 it fell to that level. I don't see it happening. What would be the recipe for it happening? Rates going higher, so keeping affordability at a very low level. So I don't see it happening. The one we want to look at, Jeb, if we had
this one right here, right? So this only goes back to 2019. But you can see the minimum, which I don't even know when the minimum, it doesn't have any context of when the minimum was, but yeah, that's not really a good slide because that's that's seasonally adjusted. So that doesn't
It's
really
seasonally
help us.
adjusted and it's monthly, so it's hard to
Yeah,
put it
that
into
doesn't. Yeah.
context
So,
there. But
okay. Yeah.
if
Anyway.
if you look at that chart, like we 2011 hit 3.5, 3.6.
Hmm.
I just don't see that happening. But the recipe for it would be continued elevated interest rates. So stagflation, high interest rates, and a recession. It could happen, but that's what it would take.
Yeah. And it's not going to happen in a year. You're not going to go from 5 million to 3 million, in my opinion. Could you continue to see them slow? Sure. I mean, but again, I'm kind of with Josh. I don't know that we're getting back below 4 anytime soon, but we will see. Let's see. Josh, what are the requirements for a vacation home? What do you need for a down payment these days?
So you can still do 10% with a conventional loan. You just have a 4+ point hit
Ooh.
for the interest rate. And the problem is lenders do not like rates as high as they are right now from the perspective that they believe they'll be going lower in the future. So any loans that go on the books right now are not likely to have an extended duration. So if you say that we need to cover an extra 4 points in that, if you don't pay it out of your pocket and you take it in a higher interest rate, the lender, the investor buying that loan is paying that 4 points for you in return for the higher yield at the higher interest rate. If they don't believe they're going to have 5, 6, 7 years of collecting interest payments, they don't want to pay it. So for the most part, you're going to want to look at portfolio lender options, banks, credit unions, jumbo lenders, if you're in the jumbo price range, someone that's going to hold the loan and has chosen not to follow Fannie Mae and Freddie Mac's monstrous increase in price hits, because even with 25% down, I think you're still paying a couple points hit. Whereas prior to February of this year, April of this year, when they implemented that, you could put 10% down on a second home and get the same interest rate as owner occupied. So they looked at it and said, well, that's not fair. There's more risk on that second home than there is on a primary, but the pricing hits are way out of proportion to any risk to Fannie Mae and Freddie Mac. So there's been talk of fighting that, reversing it at some point in the future. But as of today, you can get in with as little as 10%. You're going to want to look at a portfolio lender or a bank or credit union that holds their loans, or a broker who can actually send the loan to them for you.
Good stuff. Let's see. I am Red says, thank you, Jeb and Josh, for all the wonderful advice and knowledge. We appreciate you being here. Thank you. This one, Rivers of Living Water. Do you foresee Bakersfield, California prices going down? We seem to be growing, question mark. What are your thoughts? So Bakersfield is one of those areas that's still affordable relative to other other markets out there with regards to home prices. Now, just like any other market, they're likely to move sideways. But I will say that there's still an opportunity there where other people, if you're looking for a $400,000 home, there's very few markets where you can still find a $400,000 home in this area. And Bakersfield's not really this area, but we see people going to Bakersfield because it's more affordable. So unless prices drop significantly, which I don't expect, I think the Bakersfield area will continue to do its thing. Now, it's not going to see the appreciation that it's seen over the last couple of years, in my opinion, but it also hasn't seen the craziness of appreciation like some of the other markets, right? I don't know that it went up 40% in the last 2 years. Just because I think it was kind of on the tail end of where people started going just because of affordability. Therefore, it kind of, the growth wasn't there the entire time. Maybe I'm wrong with that. I don't follow the market closely enough, but I just think, unless something happens that drops prices more coastal, the Bakersfield market, Central California, will continue to be somewhat of a desirable area. Josh, what do you think about that?
Part of it is all of Southern California. We've talked about LA, Orange County, even to a degree Ventura. They're built out, so people are pushing further out. So you have the affordability, exactly what you talked about, Jeb, but just we have bigger population. And you talk about the net migration out of California. There are, but there's lots of people coming in and wanting to buy. So our population has grown in the last 15, 20 years. So as affordability stays at better levels, and some people just want out of the city. So Yes, it is more at risk, lower price points, more first-time buyers, more FHA buyers, so it would be more at risk than something along the coast or in LA and Orange County. But it's definitely less risky than when it was more rural and wide open with lots of new construction in 2005.
Good stuff. Brandon Clark's got a good couple of good questions here that I want to touch on. We get a lot of building questions too. So, inventory jumped to 3 months in June. Think we'll see the 6+ month in the colder months. I don't think we're going to see that this year. That means inventory would essentially need to double between now and then to some extent, or homes would need to just sit on the market for an extended period of time. I think inventory is going to build for the next couple of months, but I think there's a point later in the year where it does peak and then inventory declines some from there through the end of the year. It typically is what happens. And we see the lowest amount of inventory towards, that Thanksgiving or early November and the end of the year timeframe. Now, we're not going to reach the lowest level of the year just because of where we started the year. But I do expect some homes to be pulled off the market during that time, less homes to be listed as we get into that time. So you really only have a couple of months to add that additional inventory to get us to 6 months. I don't think that's going to happen, but we'll see. We'll see. Could it happen next year? Sure, it could. It just, a lot of it depends on what happens to rates. So Brandon goes on to say, better to negotiate credits with a builder instead of price reduction if comps are lowering. So we talked a little bit about this. We didn't really get into any detail. We've talked on the most recent podcast about negotiating seller credits. So if you want to talk about negotiating credits, you want to get a more detailed answer, go listen to the podcast we recorded last week, I believe. Actually, just posted on Tuesday. It's a deep dive into negotiating credits in this market. But one thing you can do is, in a market like this, if the homes are sitting, you might be able to negotiate the price a little bit, and you might be able to negotiate a credit as well. Now, what would you use that credit for? The design center? I don't know, maybe. Or you could ask them to lower your interest rate, right? Buy some discount points and help you get a lower monthly payment on that property. Josh, you ran the numbers recently. We talked about it a little bit. You could either lower a property by X amount or lower the interest rate, and it, by using discount points from the seller, in this case, the builder, and the payment was significantly different doing the discount point. So do you know those numbers?
Yep.
Do you remember?
We were trying to figure what's kind of a number that most people can relate to. $500,000 loan amount. If you ask for the seller to come down $10,000 in price, saves you about $53 a month. If you ask them for $10,000, which is 2 points on that loan amount, it's going to save you about $140. So $90 more bang for your buck in terms of monthly savings. So it just comes down to the difference there is, let's say rates drop to 3% next year. I don't expect them to, but if they did, if you took the $10,000 price reduction, you can then refinance to the lower rate and you got both of them. If you take the buy down, it's a sunk cost. You don't get those 2 points back. So you would have paid $10,000 more for the home. Right. So which is better in the long run depends on the future direction of interest rates. But for a lot of people, affordability is tight. So they would say, I'll roll the dice that rates stay elevated. I would rather have $140, $150 lower payment than a $53 lower payment.
All right, good. Yeah, no, good stuff. And then also your property taxes are based off your purchase price, right? So you buy a house for $10,000 less, your property taxes are going to be a little bit less. It's going to be significant, no, but it does have an impact. So just, there's variables there to consider and think about. So just know it's just not an easy answer, and talk to a real estate agent professional that can have that conversation with you and,
Jeb,
and help guide you. Yep.
The one thing that's a little unique with a builder is maybe the person at the sales office will tip their hand, or who you're dealing with there, is what's preferable to you guys. Because think about this, the design center stuff, they have huge margins on that. If you look at what quartz countertops cost from the design center versus you going out and shopping for them, they have big margins. So they may tell you, hey, we got a 100% markup on that stuff, so we can give you a huge discount on design center stuff and our bottom line still looks good. So that's different than dealing directly with a seller. Maybe ask them, What are the things you can do? Maybe they've made a deal with the builder or the lender that the builder works with, and a buy down is really cheap for them, so they want to do the buy down for you. Maybe they won't tip their hand at all, but dealing with a builder, it's always worth asking.
Good stuff. Before we get into the next question, I want to ask that you hit the thumbs up. Feel free to subscribe to the channel, bell notifications if you want to get notified anytime I post a video. Right now, it's twice a week plus this live. So if you're finding any value at all, do that. If you find that you want more than what we offer here on the show, a deep dive into a topic specifically, go to the Educated Homebuyer podcast. You can find us on Apple, Spotify, any platform out there. Again, there's about, I think there's 23 episodes that we've recorded that are specific topics, about 30 minutes on average, that, you know, down that rabbit hole, if you will, to give you the info you want. And then also we take this video from Wednesday and we post it on Fridays on the podcast as well. So this is 2 hours of information, you know, put into audio format only on the podcast if you want to get that as well. But go check it out. And then lastly, Josh, I will put up a couple of links here. If you want to talk to Josh, want to talk to Jeb, consultations, you can do that by going to those links. All right. So that gets some housekeeping items out of the way. Well, I guess one more housekeeping item that I'm going to throw up here. And that is what I mentioned earlier, newsletter. If you're interested in getting a newsletter weekly on the real estate market, articles that we're reading, things that we're following, do me a favor, go to that link and put in your name and email address and you will be added to it. It's not spam. You can unsubscribe anytime, all that good stuff. So hopefully that's helpful for you. Newsletter, jebsmith.com/newsletter. All right. So that's a lot of info thrown out there, Josh. We got a couple more good questions here we're going to touch on. Christian's got a question that he's posted multiple times here. Christian, are there any cash offer companies like Ribbon or Accept that operate in California? What do you think of them? I have no idea. I don't follow them. I have an idea of what they are. I don't really have an opinion of them because I'm not seeing them in my market. I'm not using them. So unfortunately, I'm not a lot of help for you. Sorry about that.
I have one. In essence, we have to do the loan. So they're a partner with the lender. So it's a specific lender that we use. It's one of our preferred lenders that has excellent terms. And they have partnered with a big company. And they're one of the few that does it in California. I won't say one of the only, but they're one of the few. So the big downside to it is you're paying an extra fee for that. And you end up with 2 sets of closing costs. One set is relatively low, but you're going to end up paying 1% to 2% more for the property than you otherwise would. So you got to ask yourself the question, what's the value in this? Am I in competitive bidding situations on the loans, on the homes that I'm offering in, where the seller is going to look at me and go, cool, I've got cash, I'm going to close in 15 days with no debate on that? Because there is a cost. It's not a free thing. Those companies are in business to make money. It's pretty good. It's a pretty good deal. I don't know that I would be willing to pony up that much money for that return, but I don't have hedge fund money either.
There you go. Good stuff. Let's see what we have here. Angelica says, is it a good idea to buy a model home if the builder is pressuring with credits? Depends. Do you like the model home? You know, do you like the home that's not the model? Are you going to want to do the upgrades that the model has? What's going to cost you to do it? Because you can finance the model, right? So to each his own. You know, the model home's always going to be more expensive than the others, typically speaking. But if you can get some credits, what are the credits being used for? You know, it's again, I don't know that there's an easy answer for this. It really boils down to what you're looking for in a home and what's it going to cost to buy one of the others and make it like the model if that's your taste. What are you going to use those credits for? Because in this, most models have all the you know, the upgrades in them. So you're not really going to have design credits. So can you use that money towards closing costs? Can you use it to buy down the rate and effectively have a lower monthly payment than you would by maybe buying one of the others and not getting the credit? These are all things you got to consider.
The thing there, like you said, a model home is generally very highly upgraded. So what would be the cost to make another one similar to it? And the other thing is they have designers do this. So for the most part, most people don't have great taste. So unless you have that designer taste and you want it a specific way, generally the models are done very nicely, and you then get to take that weight off your shoulders.
All right. JT Owensby the third says, are home buyer plans like, I'm assuming like Cal Haffa, worth it to help get into a first home for someone with no family to assist in the down payment, but can easily afford the monthly payment? So essentially what he's asking is, or maybe she, but he says, are down payment assistance programs like Cal Haffa worth it to use for the down payment? Josh, what are your thoughts on Cal Haffa?
98% of the clients that we deal with, when we show them side-by-side comparison between a standard 3.5% down FHA with a seller or lender credit to cover the closing costs versus a housing finance authority loan, they will prefer to take if they can come up with a 3.5% down payment, they would prefer the standard FHA. With the housing finance authority, at least here in California, different states actually have very aggressive HFA loans. But when you look at it here in California, you're paying a premium interest rate. You have a second and most times a third mortgage to cover all of the closing costs, which end up being higher on these loans because the housing finance authority doesn't pay the lender, you end up paying the lender. So when you add it all up and you have that second and third loan on there, so you owe more than the home is worth the day you walk in. Most people will choose not to go that route. But I will say, when we're looking at buy with your own money, buy with the housing finance authority money, or not buy at all, for most people, I would rather have them buy with the HFA loan. But if they can come up with the 3.5% down payment, I would rather get a seller credit for closing costs because it'll be cheaper for them in the long run.
All right. We got a couple more good questions here. Josh Benjamin says, I have a lock and shop at 5.99% with a mortgage broker. I was told if I get under contract, we would look at the 30-day rate. And if it's lower, we can just cancel. Is lock and shop a gimmick? Question mark.
To a degree, in essence, there's a cost to hedging those loans, which is what they're doing to offer you a lock over a longer time frame. And more importantly, those close at much lower rates. Some of these people never find a home. They find a home and go with a different lender. They find a home and rates have changed, and that broker moves the loan to another lender. So the pull through is very low, and we're doing extended locks. So they end up being more expensive, and the terms are not as attractive if you're not using the lock and shop. Now, on the flip side, some lenders are just saying this is a tough market. We'll take a smaller margin and we'll eat the cost of hedging it. So it's kind of a gimmick, but it's not necessarily the worst thing. And, I believe we've hit the point off of that June CPI report and the big spike in interest rates where we've probably seen the worst of rates. But earlier in the year, before every lender on the planet started offering lock and shop, it was a great idea. But now we've probably seen the peak in interest rates, and it's debatable whether it's of any value. But it's not a bad thing. I mean, you've certainly locked in your worst case scenario.
Good stuff. Rack pull above the knees. I like it. Can I represent myself in a transaction, or am I required to use a broker? So you're going to have, essentially, if you go in and try to represent yourself, what's going to happen is the listing agent, assuming they allow dual agency in that state, is going to end up representing you. Now, if you're buying a for sale by owner, you can represent yourself, I guess. But there are certain disclosures, certain things that are required in buying a property, like here in the state of California, and you need representation. So unless you're a licensed real estate agent or broker, you're going to have someone do that for you. Other states, I'm assuming, are similar. You're not going to be able to just represent yourself again, unless it's like an off-market type property, in which case you're putting yourself at risk, in my opinion. Let's see. Josh Peter says, do you believe that future rate hikes are priced in? So we've talked about the market already having a forecast of where the Fed funds rate is going to end up at, say, by December of this year. We even have, polls, if you will, based on, what the Fed's going to do at the next Fed funds meeting. But nevertheless, a lot of this, the market is aware of, right? The Fed makes the market aware of these things to calm the market and to provide some stability, less volatility out there when the market has something to expect. So do you believe that the current pricing that they've put out there is already priced into interest rates at the moment?
For the most part, yes. If you've subscribed to efficient market theory, which to a degree has been debunked, all information that's available is priced into any market at any given time. The 3/4 of a point next at the next meeting is absolutely already priced in. If you look at the other 3/4 of a point that the market is expecting through the rest of the year, for the most part, but again, the Fed funds does not dictate mortgage rates. So is it priced in? It's the things that are leading the Fed to increase rates have been priced into the market. So what happens from here on out with those monthly inflation readings and how quickly they can get under control and back to what we consider a more normal level will dictate what happens with interest rates from here.
Good stuff. Patrick says, please explain what a dual agent does. Also, the pros and cons of this. Does fiduciary rule really get accomplished for both sides? So a dual agent, not all states allow dual agency, but a dual agent is when one agent represents both the seller and the buyer. Pros, in some cases, you might have a better opportunity to get your offer accepted. Cons, that agent might be less willing to negotiate because, on your behalf, because they're also representing the seller. Now we could deep dive into this. There's obviously pros and cons. It goes deeper than that, but that's, the basis of it. Does fiduciary rule get accomplished for both sides? It's a gray area. It's hard to have an agent be 100% fair to both parties and provide the exact same level of service when you're representing the seller and the buyer. Should it be, equal? Absolutely. Is it always equal? Absolutely not. Josh often uses the example of if you're getting a divorce, and I think it's you, Josh. Is this the example? Are you going to use the same attorney as your spouse? Chances are probably not. You're going to try to have a different, party represent you than them, so that there's equal negotiating going on, so that both parties can kind of try to get what they want. You never know how hard you can negotiate when you've got the same person representing both. So, take it for what it's worth.
Best case scenario, that person ends up being a mediator. They're trying to find something agreeable to both of you.
Yeah, and I'm in a state that allows dual agency. I'm a believer that we shouldn't have it. But what I will tell you is that if we didn't, there would be workarounds that it would essentially end up being the same because of how it works. So I don't know that there's an easy solution for it, quite frankly. Anya says, does an appraiser use a sold FSBO as a comp? They can. Typically, what an appraiser is using are properties that show up in the MLS because they have a lot of there's pictures, information involved in those comps. Occasionally, I guess they could use a property that was off market as a comp. But what I will tell you is if it's a sold FSBO and it seems to have sold well below the market value or well above the market value for that case, they probably won't use it. And the reason I say this is, like, if you go back to a time, say like 2008, 2009, when there were a lot of foreclosures out there, if you had a bunch of sales, and even let's move it a little bit further forward, say 2011 or 12, when there were less of them out there, if you had a bunch of comparable sales that weren't foreclosures, and then you had one that was a foreclosure and the property sold for significantly less than everything else, they wouldn't use that comp. They would use the majority of what's happening out there because it's a distressed sale. So if it's distressed in any form or fashion, unless that property is also distressed, they're not going to use that comp. So I don't know if you're thinking, a sold FSBO has sold less. Are they going to use that to help justify lower values? My guess is probably not, unless it shows up in the MLS. And then even then it's questionable. So Josh, I don't, do you have any further thoughts on
A
that?
couple tiny little pieces of
Yeah.
information. The reason why the MLS data is preferred is it's more complete. It's easy for an appraiser to dig in there and go, okay, it went listed this date, under contract this date, closed at this price with this type of financing with these concessions. The only way to check on the FSBO is public records. California is what's it called, Jeb? It's a full disclosure state. There's
Yep.
other states that are non-disclosure states. So you're going to see in there what the price was, but we don't know. Did the seller pay $10,000 in closing costs, which would impact that value? So that's the reason why they're going to lean more towards the stuff in the MLS, because it's better data. But can they use a FSBO comp? Yes.
There you go. Tom Petty. Wow, Tom's back. I thought Tom bit the dust a couple years back here. 2-1 arms are out in Florida. Will this soon be an option in Cali? If so, could this put us in crash territory due to higher risk? Josh, are you seeing 2-1 arms? I'm assuming this is non-QM stuff, but
I think they're misunderstanding the 2-1. We're seeing 2-1 buy downs, not 2-1 arms. So it would be a 228 was what the arm is. A 2-1, you probably are honestly seeing information about 2-1 buy downs and your brain going to arms because 5-1, 3-1, 7-1 arms. That being said, there are shorter terms arms available. I have a lender that does 6-month arms. There are lenders out there doing 1-month arms. They are very restrictive on qualifying for them. It's almost like you don't need the loan. They will give you that loan. And even that, we talk about option arms and how option arms were so terrible and part of the crash. Option arms existed way back in the 1980s and never led to a crash because they came along with very conservative underwriting. So if we have that with the case, there's nothing inherent in an adjustable rate that presents risk. When you start combining it with other risk factors, no down payment, a 580 credit score, now you're making a little ticking time bomb. But for the most part, these are being offered to well-qualified borrowers with much lower debt-to-income ratios because they have to show ability to repay, so they have to put a huge payment shock on those. But my guess would be what you're seeing is 2-1 buy downs, where if the rate currently today is 5%, 6%, the lender is going to give you 4% for a year, then it goes to 5%, then it goes to 6%. That's most likely what you're seeing when you're seeing anything referenced as a 2-1.
good stuff. 500 Stoney, do you think you are better off buying a highly remodeled home or doing it yourself? This is one of those to each his own type scenarios. So, and it also comes down to, do you have the cash to do the remodel yourself after you buy it? Can you get it at a price that, by doing that cost, you're still below the cost of the remodeled one? Some things to consider. I mean, I know Josh likes redoing his own property, whatever. If I could find a property that's redone to my taste, even if it's not 100% perfect, I'd rather buy it done just because I can leverage my cost, right? I mean, if I remodel it myself, that's money I've got to pull out of my pocket to do the remodel. In some cases that makes sense. In other cases, it might not. So I think it's a, scenario. It really depends on the property and what's it going to cost you to get to where you want to be with it. Do you have reliable contractors? How long is it going to take to do it? Supply constraints, all of that stuff is playing a part in that question at the moment. But I like leverage. So it's up to you. Now I know Josh would probably want to do it himself. So.
Well, here in that answer, what you're saying is, how do we define better off? I define better off as having it done to my tastes. Jeb defines better off as I get to roll in and move my stuff in tomorrow. So it comes down to that. Is better off defined by what's better financially? The last few years, I've been telling anyone, don't buy a fixer. They're going for a higher price than they should, and dealing with contractors in this market is hell. As this sort of calms down, normalizes, we may go back to what I'm seeing. But to each their own, and know what your preference is and what you value more.
Good stuff. Let's end on one of these here, Josh. Makiba. Great show as always. How long after when I get pre-approved, how long do I have to purchase a property? So I meant to click on this one an hour ago. But
hopefully she stuck around to hear your answer.
But how long do you have to purchase a property after you get pre-approved, Josh? How long is that pre-approval good?
So lenders oftentimes will put an expiration in a pre-approval just because things do change. As long as the underlying information doesn't change, your pre-approval is still valid. You didn't change jobs, you didn't get a pay cut, you didn't stop working overtime, you didn't go buy a car, you didn't miss a payment on a credit card. All of those things can invalidate the pre-approval, but they would do that even if it happened 5 days after we finished the pre-approval. So really think less in terms of how long have I had this pre-approval and more in terms of what has changed since I had that done. So hopefully that's the good enough answer for you.
There you go. Good stuff. I just see a couple comments here like, Jeb, I'm being bombarded by doomers in your comment section. I need reinforcements. Oh my God. It's like you guys, I think the next show, or maybe it's a video that I do that I record is me reading some of these comments. I mean, you should see some of this
It'll
stuff.
be the mean tweets portion
Oh,
of the
dude, it's
show.
hilarious. Like some of these people, I mean, fortunately, I have thick skin and it doesn't get to me, but some of this stuff is hilarious. Like I think you should read them, Josh, and we should just comment on them. Maybe that's next week's show. We don't even read these. We just read the comments from another video.
Not a bad idea.
Yeah, but I
Here's the
appreciate
thing.
you standing up out there, Rihanna Keeves,
1,000%.
and sticking to what you believe, right? You don't have to believe what I believe. I don't care if you believe what I believe. That's the whole thing about this. Like you can have a different opinion. That's okay. I don't care. And you can put it in the comments. That's great. And you can talk shit on me. That's
Jeb,
okay too.
Here's what I would say though. The people who are in YouTube in the comments section telling people that are actually out living life and doing things that they're idiots and they're 100% wrong because the market is going to crash are not people that have productive uses of their time, gainful employment, and own real estate. Like there is a guy, here's a doom and gloomer, that he Jeb has backed off of the housing bust stuff, and he was actually out while telling everyone we're going to have a crash, acquiring huge amounts of real estate around the country. So again, I'm going to put stock and value in that person, even if I don't agree with them, and say, this is someone who owns real estate and is actively in the market and saying they have an opinion different than mine. I really don't care about a commenter who clearly does not own any real estate and is rooting for home prices to come down so that they could hopefully buy real estate. And we've seen this, like it's not just Diana Olick at CNBC. 2014, 2015, 2016, 2017. What did we keep hearing about, Jeb? Oh, the shadow inventory is going to come. You haven't seen anything yet. There's going to be a leg down that's going to be prices you've never seen, and I'm going to swoop in and buy them all up. None of them ever did it. So a stopped clock is right 2 times a day. So eventually home prices will have a dip, but there's not going to be a huge correction like they're hoping for. And when it does come, they still won't have the balls and ability to buy a house.
There you go. Good stuff. So we're going to end on this question real quick, and then we'll see some departing comments. So been searching for a home for a long time. Realtor hasn't been proactive. Is it appropriate to get a new realtor agent? Can I stay with the lender they use? Absolutely. You can stay with the lender. Don't need to change there. Have you had that conversation with the agent and tell them that, whatever, maybe they're not being proactive because you were doing the work. There are times when I'm not proactive as an agent. Let's be honest. So have that conversation. If you're not happy, yeah, sure. You can get another realtor. If you don't want to have the conversation, just get another realtor. But again, I think, most people, if you have that conversation, will tell you, either what you want to hear to make you stay or what you want to hear to make you find a new agent to begin with. So hopefully that's helpful. Josh, we are at that part of the show where I'm going to ask these people one more time. We're at 140 likes to get us over that. There's 199 of you on here. So I know 140 people that have already hit it aren't still in here. So you guys should be able to get us up a little bit. It helps the algorithms, helps all of that good stuff. We appreciate you. The podcast, The Educated Homebuyers in the corner there. Check it out. Josh, what do you want to add here as we depart this evening?
It's been an interesting year, and it's been an interesting week and an interesting day. So thanks for sharing part of it with us and letting us talk through the craziness.
Wow, Josh just broke the entire year down into a day. It's been an interesting 2 hours as well, people. In all I think we'll be back next Wednesday. 2 hours. Maybe we will. Maybe we won't. Maybe we'll read comments. Maybe we won't. A lot of you didn't show up tonight. So maybe we need to take a break from this. I don't know. What do you guys think? Let us know in the comments. Should we be back next week doing this again? Should we take a
Summer
break?
vacation?
Yeah, should we take a vacation? I mean, I think we're due for it. I'll actually be in Dallas next Thursday. So Wednesday I'll be here and be able to do the show. So we'll probably see you then. But we appreciate you being here. We appreciate the support. Continue to hit the thumbs up as we depart. Adios.